Good morning. We will go ahead and call to order our Oklahoma City Maps Investment and Operating Trust meeting for February 16th, 2026. Item 2, approval of minutes. We have minutes in our packet from November 17th, 2025 from the last trust meeting. They were in your packet. Hopefully you had an opportunity to review. Do we have any edits, additions, modifications? If not, I'd take a motion in a second. Okay.
Joanna, how would you like to vote? Minutes.
On the minutes?
Yes.
Okay. Okay, the minutes are approved. Thank you. Moving on to items for consideration. Item 3A, the General Manager Report for the period ending December 31st, 2025. Randall is here to present. Good morning.
Good morning. Randall Lewis, Assistant Finance Director. I'm here in lieu of Matt Boggs as he has moved on from the city and taken another position. So you'll see me for at least the next couple meetings. Not really going to talk too much about this report because Doug's going to go into more of the why in terms of why we're above corpus. But this is as of 12/31/25. It's showing you we were on average 30% above corpus for each of the projects. We did fund 2 projects this past year, the Innovation Hall as well as beautification, which total $447,000. And we have $86,000 in money market to pay claims as they come up without having to sell investments.
Okay, thank you. And we're thrilled that you're here. Any questions of Randall? Okay, if not, take a motion in a second to receive this report. Okay. Bob, how do you vote? Okay, motion's received. Thank you. Moving on to item 3B, receive quarterly investment report for the period ending December 31st, 2025. Doug Anderson is here to report. How are you?
Good, I'm great. Good morning,
Would you like
everyone.
to introduce your guest?
I would. Stand up, please. Today, being President's Day and the fact she's out of school, Claire Marie Anderson is with me. She is the boss today. This is not her first board meeting to go to. She enjoyed the last one very much. And I told Randall if she starts to yawn during my presentation to...
Highly doubt it. Okay. Thank you both for being here with us.
Maybe, maybe not. But she is in 6th grade at Holland Hall Elementary, or no, it's middle school now. And Claire enjoys musical theater, she has a phone.
Okay.
Unfortunately, she enjoys reading, and she plays softball.
Very good. Here, thank you.
The youngest of my 3, allegedly my favorite. Although we have the ranking this Christmas.
Yes.
We'll have to revisit that. Okay.
We're thrilled that you're here, Claire. Thank you for joining us.
Thank you for being so welcoming. Good morning. And as sad as I am to see Matt go, I'm thrilled to be working with Randall again. He's a great guy and always great to work with. So today we will go over the quarterly reports, we'll go over a January update, and we'll also review changes to the investment policy statement that we discussed last time. I'll be relatively brief here as results have been quite strong across all periods in the portfolio. Mitchell, are you ready? We'll go through market environment, and I'll touch on a few things here, so if you could, I can do it? Okay. All right. Skip over the text, but on this chart in front of you, page 3, quarterly performance and the 1-year performance for the major market areas that we track, and you can see on the top, the quarter, U.S. equities were up 2%, 2.7 for the S&P 500, you can see pretty strong performance across the board, but then mid-caps, a little bit of underperformance there. Russell 2000 did fairly well. The gold bars there, that's international equities, and for the quarter, they were strong. For the year, they were very strong, and fixed income was fairly modest. Again, we'll be watching the 3-month T-bill, as that's very tightly correlated with the federal funds, Fed funds rate, which was cut twice last year, and there's all eyes on that as far as stimulating economic growth in the United States. But I will say that economic growth in the U.S. Last year was fairly strong. Thank goodness for AI. The AI build-out, both from energy infrastructure and the actual data centers themselves, provided about 1% additive growth to the U.S. economy last year. Without that, we would have been below target. But as far as inflation, fairly moderate. It appears that we've gone through that, the worst of that. And employment, unemployment is about 4.3%, which is below that 6% threshold, which means that we're slowing down. So knock on wood, it's kind of that Goldilocks situation again. We're not growing too fast. We're not deflating too much. And corporate earnings have been very strong and accelerating through this period of time. So you can see U.S. equities up for the quarter about under 3%. International equities at 5%. And again, a good portion of that is the translation effect of a weakening dollar versus other currencies out there. And fixed income anywhere from 1.7 to 1.1%. Going down to the second table, 1-year performance for the U.S. equity markets, we had double digits across the board, right? So the S&P 500, which is our largest allocation, at almost 18%. Mid-caps and small caps, while they had periods where they did outperform, did lag, but still the worst spot, the worst segment of the U.S. equity market last year was up 10.6%. That's a good environment. Now, even though the S&P was up 17.9%, it was about last place as far as regional equity markets go. And you can see how strong the international markets were. ACWI, ex-US, so that's all countries except for the US, was up 32% last year. EFA is the so-called developed markets, 31.2%, and even emerging markets did very well at 33.6%. A good portion of that is materials. So just think commodities around the world that we need for construction. A lot of that comes from emerging markets. And then fixed income. So at 7.3% for the U.S. aggregate, remember we're targeting a 4% total fund return here. So if I take all three of those major areas that we invest in, U.S. equities, non-U.S. equities, and even fixed income, and the worst one was almost double of that 4% rate. And it does, thinking about this year and thinking about everything from the very beginning of this fund, it's hard to believe that we're coming up on 4 years. Yes, Kevin?
Quick question. How is ANCO thinking about its asset allocation models with China's sort of rise to, I wouldn't say dominance, but
Sure.
more influence, especially in countries, in continents like Africa,
Yes.
Europe, now the UK. I'm just curious if the international market momentum changes the asset allocation structure overall with some of your model portfolios. And I don't think we're in any of those, but I'm just curious how ANCO is
Sure.
thinking about the possible restructuring of those.
Please don't take this the wrong way. It's Mariner? Powell?
Mariner, whatever.
Formerly known as, yes.
Kevin, we've known each other a while. It's
Yeah.
okay. So I would say the most important impacts, China's emergence is probably supply chains, right? You know, and it's not lost on me that they are advancing in hyper-efficient manufacturing. You know, there's a real reason that most countries have pretty high tariffs on, say, Chinese electric vehicles, because they just can't compete with them, right? Because the supply chains are there. As far as our allocation to international equity, we're in an index fund, right? So as China grows and becomes a bigger part of that, as Taiwan, which is highly related, becomes part of that, I think that that will come out in the allocation of the index fund. As far as having an active strategy going to or from, I would say that that's one of the more rapidly evolving when it comes to boards like yourselves. I remember in the aftermath of the Ukrainian invasion of Russia, everybody got really, really attentive to China, Taiwan. And I've seen actual folks out there. Now, this is not the official Mariner line, it's just my observations, but I've seen folks in boards like yourself request portfolios, because if you look at the emerging markets index, right, if you're investing only in EM,
Yeah.
China, Taiwan, that's more than half of the index. And so I've seen a lot of folks say, you know what, we want emerging markets exposure, we just don't want that much China, Taiwan. Because if you remember what happened, you know, it'll forever be burnt upon my memory when Russia invaded Ukraine was very, I mean, it was like 4 days after we made the initial investment here, and markets were in a pretty decent downdraft for a while. So I would say that do we have any China-only exposure? No. Have I been observing what I would say are more contrarian managers out there investing in China recently? Yes, I have. Right? China is today, as far as American institutional investors, about where energy was 4 years ago. It's not very popular because it seems to be an unanalyzable risk. You know, if something does happen military over there, that's going to be a problem for everyone.
Thank you.
Thank you. So when we go on the following page, there are some interesting takeaways from this one. One, what happened to mid-cap growth during the fourth quarter of last year? And I would say the issue there was this tiny little company called Palantir, which was part of the mid-cap index, even though it's a gigantic company. So it entered and then exited the mid-cap growth index last year very rapidly. And so that caused some drawdown in the fourth quarter just because of the index structure. But when we're looking at the trailing 1 year for large caps at the top, mid caps and small caps, you can actually see that there's a dispersion of results. So it's not all the same pattern there, right? You can see amongst large caps, growth outperformed value by 2.5% for the year, and the same as on the Russell 1000. But you get down to the mid-cap value, or you get down to the mid-cap, and you had value outperforming. And when we get down to the small caps, you can see it's pretty close. But what this is showing us is that the market is not monolithic, right? We have exposures to large cap, mid cap, and small cap. And while large cap, and especially large cap growth, think Magnificent 7 or 8, if you include Broadcom, that has been pulling a lot of the market's attention. And when we go through January, we'll talk a little bit about that. Things are evolving, right? We are seeing some changes, and that's why we have asset allocation defined and we reallocate to it. I'm going to skip over these slides, but again, one of the things I want to, 5 years ago when we first started here, if I would have shown you this chart, I'd say about half of the top 10 largest on this slide were on there, but they were in different positions. Again, 3 years ago, NVIDIA made chips for computer gaming, and now they're the largest company in the United States, and they're 7% of that index. And then you have Apple and Microsoft, Amazon, and I don't know if you've been following the markets the last couple of weeks, but it's been a rotation even here, right? Folks are saying, well, if we have AI, doesn't that make software almost an inefficient way to run computers the way we used to? Makes it almost obsolete, but still Microsoft is one of the largest companies out there. So evolving situation to say the least. And then as we go into international equity, this is what I wanted to show here. Again, Kevin, just to talk about what you're saying. On the right-hand side, you see the total developed markets here. So China and Taiwan is 14% of that 30% in emerging markets. As you go down that list, I mean, except for India and Korea, they dwarf all the other emerging markets. And then just to also reiterate some of the changes that have been going on in the overall world, Japan is still the largest on the top portion of the table. This is the so-called developed countries. Japan at 22%, UK at 14.9%, France, Germany, and Switzerland. 5 years ago, Germany was 1 or 2, but because of poor energy and industrial policies, their GDP has gone down dramatically. I was meeting with investment managers on the East Coast last week, and one of them was an infrastructure manager, and they were talking about the projects they've had throughout the world, and they were talking about airports and pipelines throughout the world, and they were talking about rail. They had a project that was rail lines in Europe, and I asked, well, how is that one going? And they're like, well, it's under revenue budget because there's just no industrial rail traffic compared to 5 years ago in Europe. They're not making as much, and so they don't have any freight traffic going on, which is opposite of other places like China is going on. So let's talk about the portfolio itself. I love this chart. Right, this is the one that reminds us of really what we're supposed to be doing here. Randall earlier showed how much we are above corpus on each of the individual funds in that summary, and you can see that as of December 31st, the total contributions were $115.5 million. You can see that distributions just under $1 million, gains of 35.7, and just recall where we were that first 6 months. It did not seem like we would be here. But again, markets have provided for us. The ending market value is $150 million. And of that difference, that income was really important during that first year. Remember on this slide, we did pivot, right? We pivoted to more stable assets because the most important thing to do in the early years was 4%, right? We wanted to guard that 4%, and we did that by taking some money out of equities and even fixed income and putting it in cash. And that was a difficult decision. Probably not one we're going to face again, knock on wood, but it was the right decision at the time. Going into the allocation of the portfolio, very stable. Started the quarter at $148 million, ended at $150.3. And our management structure is simple. It is simple, it is liquid, it is streamlined, and it is very low cost. And I think that in today's market, there's not any compelling reason to be investing in real estate, private equity, private debt, at a portfolio of this size with the liquidity needs that we foresee. Again, this is very inexpensive exposure to the market indexes, which have become incredibly difficult to beat. Now, going on this slide, we're about to discuss making changes to this. This is the target asset allocation. We have not addressed changes in this since the beginning. Remember, we did about a year's worth of work on investment policy on target asset allocation because over the 40, 50, 60-year lifespan of this fund, this is going to be the main determinant of the returns that are produced. So as we look at this, you can see that the gray bars are the acceptable policy ranges for the targets. The green arrows are where we are within those acceptable ranges, and the red triangles are where we are out of range. And you'll see that on this, fixed income indicates that we are out of compliance. Alternatives in real estate also indicate that we are out of compliance, and the main reason is that we have not allocated to those two categories, and I don't think we're going to allocate to those categories anytime in the near future. So that will be reflected, and if the policy changes are voted on today and accepted, then we will redo this chart to reflect the state going forward. And again, let's go to performance, my favorite part, especially right now. The total fund, and this is as of December 31st, so for the fourth quarter, the total fund was up 1.71. For the year, 13.09. That's a fantastic result. I think that this is a well-calibrated portfolio in terms of risk and return. And then for the 3 years, annualized at 12.71. We tripled the spend rate over the last 3 years and I think, yes, Brent?
When I look at this, I'm just amazed at the fact, and I know that the Fed rate has all to do with it, but on the cash side, we're making our minimum 4% on our cash.
Yes.
All the while, we're making really good money on all the other stuff. I think that's just,
Yeah.
that's probably, you've done this a lot longer than I have. That's not normal, right?
Well, over the last 40 years, no.
Okay.
Over the course of my working career, I mean, at the beginning, I remember hearing, back in the early 80s, interest rates got up to 18%. It was the easiest time in the world. And I'm glad we didn't go back there.
Right.
But we saw interest rates pop up in 2022, and we took advantage of it. Remember, we've been holding cash, and I think it's a great idea to do that. We're not taking a penalty by holding cash. In fact, we're making over our spend rate, which is fantastic. Again, the environment that we have been in since the inception of this fund has been unusual because of the volatility that we saw initially, and then 2022, which is extremely painful, but we were able to take some of that pain and convert it into income that we've seen here. And then obviously since inception, 6.91, and these are net of fees, investment management fees versus 4%. Seemed like that was going to be a really tough hurdle to meet, but we are there. And the really important point right now is to continue compounding on top of that, right? We were careful and we were cautious at the beginning. We took some money out of the equity market, and then once we made sure that we had our 4%, we added that back in, and it's been great ever since. So looking down our 3 domestic equity managers, our funds, all index funds, and with the exception of the small cap fund for the last year, top quartile, but all of them are tracking their benchmark very, very closely, nicely. The international equity, fantastic. It's been so long since we've seen outperformance from international equity, 32.62%. And remember, this is an index fund also. And then for our active management, that's the fixed income side, those results have been fantastic too. You can see Dodge & Cox, 8.32%, outperforming its index by 1%. On this asset category, that is a fantastic result. And you can see the 3rd percentile ranking. That means they outperformed 97% of other fixed income managers.
Doug, when you look at the international, though, and you see 32.62% year-to-date growth, some of that has to do with the value of the dollar.
Yes, it does. About half.
You knew my question. All right,
Yes.
Thank you.
And again, Kevin, just to go back on that one, currency effects, those are important. And the US dollar's been pretty strong before last year, which has been negative, but not in the same magnitude as last year. Currency movements last year were pretty significant. And I guess this is the other side of the coin of Liberation Day. US dollar has been declining.
Yeah.
And that helps our foreign equity exposure. So again, looking just to calibrate where these portfolios are in size, the single largest one is Dodge & Cox, right? And we want to keep it simple. They're cautious. They're very competent at what they do. And they outperformed their benchmark by 1% last year. The next largest is going to be the US equity, the S&P 500 index, 27.9%, and it was up 17.86. As a matter of fact, when you follow that all the way over to the 10 years, we've not been invested with it, but this is a mutual fund, so we can show that mutual fund outperformed this index fund outperformed 90% of managers in that portfolio. And again, it's a really hard sell for me to say we need to go active on large cap ever again. It's so efficient. So much of the fund flows go to it, and it really is helpful. And remember, if those large companies start to decline in value, they become a smaller part of the index. And the ones that are rising become a larger part of the index. And I heard it's a pretty coarse term, but some people have called it a self-licking ice cream cone because it just keeps getting better and better and better over time. Okay, with that, we need to cover one final thing. So there are no material changes in any of the portfolio managers or any of the organizations. Again, with index funds, we avoid a lot of that back and forth that if we have active managers. We are active in fixed income because that is an easier benchmark to outperform. And not only have we outperformed the benchmark by a large margin, we outperformed 97% of fixed income managers over the last year. It is easier to select and maintain high alpha investment managers in fixed income. This is expenses. This is very important. The largest allocation, like I said, is the Dodge & Cox Income Fund. That's 42 basis points. That's very attractive. The second largest is the Fidelity 500 Index Fund. It's actually 1.5 basis points. For some reason, we can't take it out to all three. So your $41.86 million portfolio, estimated annual fee is $6,279. That is incredibly attractive fees for a portfolio of this size. And for the total fund, 19 basis points. I've seen multi-billion-dollar portfolios whose fees are, we think they're great if they're at 35 basis points. So again, we're getting everything and more that we're paying for out of the investment managers. So with that, I'm happy to take any additional questions about the fourth quarter summary.
Okay, any questions for Doug? No? No? Were you getting ready to ask a question? No? Okay.
Doug, on page 19, are those performance numbers net of fees?
Okay, yeah, this is funny. Thank you for the question. It's an interesting sort of strange thing about our performance reporting system. So if you look at the very top line, it says total fund composite gross, and then below that you see total fund composite net, because these are all in mutual funds and the fees are deducted from the market value there. Those match up perfectly. So yes, those are net of investment management fees. It's not net of custodial fees. It's not net of our fee, but those are all very reasonable. And then when you look down at all the index funds and the bond funds, those are also, because they're all mutual funds, institutional grade, those are also net.
Okay, any other questions? Bob? Nothing? Okay. If not, I would take a motion in a second to receive the investment report ending for the quarter ending December 31st, 2025. Oh, oops. There we go. Motion passes. Thank you. So moving on to the investment reports. No, we've already done November and December, but January 31st, the monthly report.
Thank you. So here's the market environment for the month, or all periods into January 31st. Results were good, positive across the board. One exception is the Russell 1000 growth, and remember that's the Mag 7. Those have had some issues recently. But good news is that when January starts out positive, generally speaking, the year is positive when it comes to U.S. equity markets. It's called the January effect. I was reading a book that was written in the 1980s about it over the weekend. Those are still useful. They still have books about this. But as we look at the trailing 1 year, the S&P, this is again February 1 of last year through January 1st of this year. S&P up 16.35%, which is fantastic, and you can go down to the last two rows of the equities table, 31.18 for EFA, and then 42.84% for the emerging markets. We are starting to see, if you watch markets a lot, you'll notice that commodities have become a big deal. Gold, silver, also industrial commodities are performing very, very well. I'm not going to advocate that we have a targeted allocation to any of those, small cap and mid cap, do have exposure in our indexes. But then looking for the year-to-date sector on the lower left-hand side, so this shows you the January performance of all of the individual sectors of the S&P 500, and then the S&P at the 1.45%. That's a pretty significant change there. If you look at the poorest performers, financials, second poorest is information technology. Both of those are negative, even healthcare slightly negative. S&P is up 1.45, and look at the far left-hand side, 14.43 for energy. Just fantastic for that period of time. And then we have the 2025 sector returns, where those are, again, the S&P is up 17.88. And again, over the quarter, or for the month, or the year to date, what we call the heat chart on the upper right, or the upper right-hand side, small cap value is the best performer. Again, this is why we have target allocations over time, and we don't switch. For the month, up 6.86, and the worst performer is going to be large cap growth at negative 1.51. Again, we're long-term investors. We're not going to try to pick the best one quarter to quarter, year to year. We're going to have allocations to all major asset categories, and the ones that perform best are where we are going to draw funds off of, either to rebalance or to pay for capital projects of the trust itself. Even better on this one, again, no changes to asset allocation. And we actually increased the since inception rate of return, and that's an annualized figure from 6.91 as of January, or as of December 31st, and as of this look, it's 7.23. Trailing 1 year, 12.52. Not a lot of significant changes here. All the benchmark, the index funds are tracking their benchmark. Great performance from the international equity for the quarter and the year, or the month and the year. And again, notice we have the change where the S&P 500, or the Fidelity 500, was best performer for the last year, but it's the worst performer for the month. And again, that's why we have allocations to all of these. Bond funds did great too. So, any questions about January?
Any questions on the January report? Okay. If not, I take a motion in a second to receive the monthly reports. Okay, the motion passes. Thank you. Item 3D, amendment to the trust statement of investment policies, guidance, and objectives. Doug.
Very good. I want to thank Mitchell. He was very helpful over the last couple of months, and mostly last week, on this. And like I said, I was traveling last week, and we were talking on Monday. I was at an airport, of course, and Mitchell was helping out with this, and he was extraordinarily helpful in getting everything in order here. So last quarter, we talked it was time to refresh the investment policy statement, and I agree.
Can I ask you a question
Yes,
before we
please.
get into this stuff? When you look at the international and how the international, half the income, half of the growth or the excess is based on the value of the dollar and everything. Mm-hmm. When you're reinvesting, would it be wise to wait to reinvest when the dollar is in a different position? Or, again, we try to be long-term investors and not try to play the game, and I totally understand that, but what are your thoughts?
Thoughts are that currencies generally, so you have currencies and then you have earnings, right, of the companies underneath. So one thing is that a lot of those companies are hedging the currencies that flow onto their individual income statements. Right, so you have that kind of mitigates it. Last year was a highly unusual environment. We haven't seen currency moves like this, and we haven't seen, I mean, honestly, it's a sort of re-envisioning of the international trade relationships. We haven't seen that. I would say that's a great question. I think that over time, currencies work out. I think that one of the main, or I would say, a significant reason we invest in international equities is the currency diversification, right? The US dollar has been in an unusual place as the world's reserve currency since the end of World War II, right? And that puts us in an interesting environment, but that doesn't mean it's always going to be that way. And as much as the United States has the most successful companies in the world by many measures, size, earnings growth, there are great companies outside of the United States. So the currency, I would say we shouldn't time it. We want some currency diversification. And if the dollar goes back, it will probably do it gradually, right? And so you have two effects. The dollar going up in value means it's also better for those foreign companies that are selling into the US market. That being said, I don't think that there's any information that we could use to time that effectively. That's a great question.
Is a great question. Good question, Brett.
It was just a fundamental question, but thank you.
Yeah.
I appreciate that.
Yeah.
No, I mean, I appreciate you saying it's a fundamental question because in most periods of time, it doesn't have an appreciable effect, right? Last year it did. Last year was the first year it has had an appreciable effect. Probably 20, right? It's been a very long time since we've seen the dollar weaken like that. As a matter of fact, we were probably underweight. I'm pretty sure we were slightly underweight international equity before last year. So again, the fundamentals are we have a long-term target asset allocation. We have exposures to different types of equities, both US and non-US, and currencies in the non-US. And I think it's good to have that. And I don't think we can outthink the market on this one.
Doug, general question. How is Mariner selecting the indices for comparison for the funds?
For comparison of these, so you will notice that most of these are not actual index changes, they're name changes, right? Not in the policy. Oh, in the policy?
You gotta give me a second. There you go.
Not in the policy, but back on the previous reports.
Okay, so how do we
reporting.
select? So
Well, I mean, that concept triggered my question by reading the policy changes, but it was something I was thinking about earlier.
right, so in your portfolio, it's really simple, right? We have, so the indexes, or the index funds you have are married to their indexes, right? So there's no selection there, right? The S&P 500 index fund, we're going to put it to the S&P 500. And we do look at those from time to time. So how deeply do you want me to go?
But for the active managers,
We're active managers.
which I guess would just be Dodge and Cox and the other one.
So those two active managers, those are the preeminent benchmarks in the space, right? So the Lehman Brothers aggregate is, or Lehman Brothers. It's not Lehman. You got me on that one. It used to be the Lehman Brothers, but as we know, then 2007, 2008 happened. So that Bloomberg US Aggregate Index has been the preeminent index since the beginning of bonds were traded in portfolios like this. So there's really no alternate to that. That is what all core bond managers use. On the fixed income side, or on the high yield side, that one has been evolving over time too. And you look on this slide, so item number 3, it used to be the ICE BOFML High Yield Master 2 Index. This one, the Bloomberg US High Yield 1% Issuer Cap. So what that does is it takes the high yield market and unfortunately, bonds, so think about this. So the more bonds you issue, the more bonds you have in the market, which means that you become a bigger part of the index, right? So if Company A issues $5 billion in bonds and Company B offers $10 billion in bonds, Company B will be twice as much in the index, right? that's not necessarily a good thing, right? The reason that it's capped at 1% on this one is that we don't want to overweight the most debt-ridden companies out there. So this one, it's a structural idea that we do not want to, we don't want to be investing in debt or benchmark our manager to invest in the most highly indebted companies out there. We want to have a more neutral stance, and that's why it's the 1% index. Yeah, I would say that, the indexes that are used for all of these asset categories, usually there's one preeminent one, right? And then you have folks out there like Vanguard will not pay Russell to use their indexes, so they use a different kind, and that's what we compare them to, but they're roughly comparable. Did that answer your question?
Not really, but we can discuss it later.
Yeah, okay, thank you. Just stepping one step back, the benchmarks that we have are widely accepted in the institutional world. And to become widely accepted in the institutional world, they have to be rigorous, they have to be transparent, and they have to be observable. Okay, so on page 7 here, you can notice some of the major changes. And Mitchell was kind enough to provide a summary of the changes. I thought that was very helpful. Thank you.
Is it the same as this page? Okay, got it. Thank you.
And this is a fantastic overview of the changes that were suggested. So if you will keep that alongside while we're going through the policy statement. And guys, thank you for your patience on this. Policy statement discussions are amongst the driest and most difficult ones to have in a board meeting, so I appreciate your attention on this because policy statement. Pardon?
Good governance is important.
It's very important.
Yes.
So on this, on page 7 here, you can see that we did update the benchmarks. Some of them are name changes. Honestly, we've been using the Bloomberg US High Yield 1% in your report because it's, in our eyes, a superior benchmark. Number 4, you can see we eliminated a section here, active duration fixed income. This was something we were contemplating investing in at the beginning of at the outset of this trust, but as of now, we are not. That has been a very difficult asset category to invest in, and I don't see that changing anytime soon. It was meant to be a counterbalance to equities because it's investing in long-term treasuries, but at that time, looking backwards, it had been a very good hedge. Especially 2022, it was not, and I don't really see the reason that we will be investing in it. So this is a part of the policy statement that was maybe someday in the future we will invest in this, but I don't see it happening right now. And as we go to this, again, another index name change. And then this is the big important change here, and I would say it's not hugely important. It doesn't represent a change of how we are investing today. If you would take the page that Mitchell handed out and turn it over, it compares red lines and tables like this with lots of numbers are difficult. And what it shows you is that we have eliminated the active duration fixed income, the real estate, REITs, and the alternatives, and reallocated that to existing asset classes. This is the crux. There's not an appreciable change in long-term expected returns from where we are today, but this will change the allocation index that we compare the fund to going forward. So what this table shows us is our target allocation. I checked the numbers about 8 times. It does add up to 100. And then the minimum and maximum, it's an equal range on either side of those.
And Doug, I'm going to go ahead and ask, does anybody have any questions or discussion on the reallocation percentages?
I have just a quick question. I haven't compared this to the most recent quarterly report and such, but making these changes to the targets, will that result in rebalancing?
No. Well,
You just move more towards where
it
they're at
might.
now?
We will look. But if you remember, if you go back to the quarterly report where it showed we were out of range on fixed income, I believe we'll be in range now.
Okay.
And if we do need to withdraw funds for expenditures, then we will use that opportunity to rebalance to target.
Okay.
So with the volatility we've seen recently, it's hard to say exactly, Bob, but if we need to, we will.
Okay.
And the way that it's arranged here is that if necessary, Randall and I would coordinate on that to rebalance the portfolio.
Okay. The last paragraph of the policy says that we'll review the investment policy on an annual basis. Does that need to be changed? I noticed the last time we did a full review is like 22.
No, it won't change. I think we should. We were a little bit, I think we're occupied by other things.
Okay.
Bob, that was my exact, I was sitting here thinking the same questions. Like, when is the last time we reviewed the policy? Because I was just saying to Brent
Right.
that I don't feel like we've had enough time to actually look at this ahead of this meeting, such that I'm going to abstain from voting on this approval, but everyone else can vote. But I just feel like I haven't had enough time to look at it.
Understood.
I mean, I'm thinking that we would just set up an annual,
Review.
at some point, review at a specific meeting each year. And there may not be any changes. It's just you guys looking at it and saying, we don't need any changes. But I think that needs to be reported to the board just to say it's been looked at. But I was just curious about that because
You know, I think that would take your point. I think that looking at the policy over previous years and before I mean, we did have a few questions that went meeting to meeting about the asset allocation. But I think that, yes, that would be a good idea to have a formal review in the minutes, especially. But I think that also, hearing some of these questions, it's probably a very good time to have another educational session, right? Solicit areas of interest from everyone, and then we develop the educational materials and we sit down and we hash through it. That first year, I don't know if you remember, first year and a half, we had a lot of educational meetings. I think they were very useful to get everybody on board, especially after we had the drawdown because of the invasion of Ukraine. But yeah, I think that's a great point. I think formal, write it down, and then also have a formal education schedule going forward too.
Yeah, I think that's a great suggestion, Randall. No, if you could just kind of remind us that, kind of, and I think January is probably a good time, maybe December, but kind of right around the turn of the year.
I agree.
Okay. Any other questions? Okay, I'm sorry, go ahead. While you were on this page, I wanted us to, entertain any questions that you have, so please continue.
That is, per Mitchell's summary, these are the changes. Again, it was not significant changes to anything in any of the policies or guidelines. The asset allocation, we sort of brought it into where we are investing today and how we look forward in the markets. And beyond that, those are the significant changes.
Okay. So with that, any further discussion? Okay, I would entertain a motion in a second to approve the amendments. The motion passes. Thank you. Doug, is that it, or do you finally get to sit down?
Finally, it is.
Okay, all right. Thank you so much.
Thank
Appreciate all
you.
your information, and I agree. I think kind of going through a little education, and we may end up not doing it every year. I do think the asset allocation we need to do every year, but the cadence of kind of an information education process, yeah, maybe every couple of years or so, but we'll see how we go. Okay. Moving on to item, Kevin, did you have?
Madam Chair, should that be a governance committee that is set up to collect that information versus Doug doing that?
Doing which part?
Education for the board.
It's a very good question.
I think it should be a
Yeah.
governance committee thing,
Right.
which I don't even think we have a
Yeah, we
governance
don't.
committee.
We don't have any committees. So, yes, let's talk about that and how we would execute on that.
Okay.
Because that's probably not a bad idea. Probably good governance piece, but I don't know that we want to get into a committee structure. Yeah, let's think about how we organize that.
Okay.
Okay, thank you, Kevin. Okay, moving on to item 3E, ratify claims for the period ending February 3rd, 2026. We had 6 claims totaling $34,896.92. These were for audit expense, custody bank fees, and investment consultant services. And I have details if you'd like to go through that. Otherwise, I take a motion in a second to approve. Okay, the motion passes. Okay, coming back to Randall, item 3F is request for proposals to be advertised for investment consultant services. Kind of want to talk us through this?
Yeah, it's hard to believe, but we're in the last year of our investment consultant contract with Anco/Mariner. So looking for approval to go out for RFP. That's not tied to this. That RFP would go out tomorrow and would remain open until March 31st. We would then form a committee and look at coming back to the trust at the August meeting and have a contract in place for September 7th.
Okay, any questions? Okay, if not, I take a motion in a second to approve. The motion passes. Thank you, Randall. Item 3G, resolution authorizing the distribution of funds for the fiscal year 2027 equal to at least 4% of the average market value of the investment pool. And I guess that's Randall.
Yep, so just some background of process on this. The resolution is written in a way where the dollar figure is blank, and so we're looking for a distribution percentage from the trust to allocate potentially to the projects. After that approval happens, tomorrow we would send letters out to the city partners who manage the projects so that those funds would be available for request now through the end of the fiscal year. So nothing, no decision that's made today is going to result in an immediate sale, but those funds will remain invested in accordance to the policy. So here we have the trailing 12 calendar quarters market value of the portfolio, which was $134.7 million. We have in the spending policy that we want to allocate at least 4% of that market value to the projects. So we have modeled here what that distribution looks like at 4% for all of the projects. The 2 projects there notated in blue are the actual 2 projects that received distributions this year, just so you know what might be likely to be requested. And it shows you what the breakout looks like for those projects. As we talked about earlier in the general manager report, on average, they're up 30% above corpus, so they would remain at least 26% above corpus after these distributions potentially. And it's dynamic, so if you guys want to model something different out or look at a different percentage, we can do that.
Do you know, Randall or Mitchell, either which, because I'm asking this question because a specific project, it took a while for them to get their operating agreement in place. Do you know which of these projects have the operating agreement in place with the governing city department? Do you know that off the top of your head?
Yeah, the
Okay.
two that have, so innovation and they're with
Beautification.
economic development, and then beautification is through
Okay.
parks.
I thought civil rights got theirs completed.
I know they were working on that.
Okay. Well, I know it was the civil rights the executive signed their agreement in December, I believe it was. So you might check on that one. And I would also check on Family Justice Center, because they will likely, their facility will likely be open in the year 26, if not the very beginning of 27. So you might check to see if they, because, the other projects are not going to be online for a little bit. I guess what I'm sharing with the board is likely, I would anticipate that in addition to innovation and beautification, I'm very confident civil rights will want their allocation. Family Justice Center may or may not in the next fiscal year. So with that being said, any discussion about the percentage? I know in previous years we've had a discussion, but any questions about, are we good with the 4%? Kevin?
Madam Chair, I was asking Brent about the available distribution balance. So this is for the fiscal year or for the calendar year, but what is their available distribution total balance? Is that not this, or is that something, is that
That is-
information elsewhere?
So go ahead, Kevin.
I was
Randall.
just going to say that this would be the available distribution, the amount that you're approving currently to be made available for this coming year.
But this is just this year, right?
Right.
So I guess what Kevin is, I'm assuming
Yeah.
your question is, so for example, civil rights, they have not previously taken a distribution. And I think what we had talked about is that that as an operator, that they had the choice to take it, to leave it kind of for available use, or to have it reinvested. Is that kind of your question?
Sure,
And
so-
so for any of these projects that do have their agreement in place but haven't taken it, do we know what the total available distribution is?
So what we've done with distributions that have not been taken in the past, they've remained invested, and the available distribution now is larger because they remained invested. We have not made those continuously available in terms of aggregating those amounts, because if you do that, let's just say a project that hasn't taken any funds, that distribution, there could be 10 to 12% that's hanging out there in terms of being able to be pulled down for that project.
I think another way to look at it too is we invested $110 million. And of that $110 million, we're at $134 million, and we're more than 134, we're 152 now. But based on this, so the delta is between the 110 and the 152 gives you 42 million. But again, we go back to, we can only allocate 4% annually.
Yeah.
And so the delta for every one of these projects would be what was initially allocated, what we've earned, what they've taken out. And so to me, there's a significant amount left of distribution that's for those projects, but again, they're restricted to only up to a certain
It's
percent.
at least 4%.
At least 4%.
Right.
Okay,
And it's
yeah.
just, whatever the trust determines annually. Right. Like I think one year, the first year we did like 2% or 2.5% or something. Right. But
It doesn't roll like vacation days or something?
we said that it would. Yes. We had previously determined, because we knew that there were some projects that weren't, and I think it's kind of played out the way we thought it might. So for example, and I hate to keep harping on civil rights, I just had the conversation with that organization for a while now, that they didn't have their operating agreement in place, so they couldn't take their distribution last year, or for this fiscal year, but they anticipate that revenue, because we as the trust had determined, like I said, we opted for 3 options, okay? Either they can take it, they can not take it, but have it held, like, almost, I'm thinking about in my foundation world. You keep it almost like in a spendable, but you don't take it at that time, but you have it held and available, or it's just rolled in because you don't need it at that time and you want it to continue to grow, right? Mm-hmm. So that's what we had discussed, that's what we had determined, but is that,
So, for example, with civil rights, their available distribution this year is 450,000, but I don't know what it was last year, so
Right.
let's assume it was 500,000. So does that mean they have close to $1 million of available distribution to them?
I'll say I don't think that's something that's covered in the spending policy, and probably should be. This really is where the market values were at the end of this year. Just looking at this distribution for this particular year, there's not an aggregated component within here, and what was approved, 2 years ago at the 2% and 4% during last year, because I think that would cause potentially a larger swing in terms of, how much they could pull down from each individual project. So it's not really covered in the spending policy in terms of if you can roll that forward to be pulled down at any point, or if it's kind of a one-time pull down per year. We've kind of been operating in, they have it available for 1 year. We haven't, been thinking about them aggregating it, but it's probably something that we should cover in the
Yeah.
spending policy.
Oh, okay, I thought that's what you were covering.
right. Well, it sounds like, and if it's not in the spending policy, I think you're right, we do need to make that addition, if that is what the trust still wants to do. So, do we want to have a discussion about that today? Do we want to table that until our next meeting?
Well, I think we need to give staff direction because we're at budget season time, so they can allow for the budgeting of the funds. So I would recommend that we go ahead and come up with a percent and do that. But I think we need to have a session where we can sit around and talk about this in more detail about the reality of, I was allocated 4% last year and I didn't need it. Okay, so I was just allocated it. But that doesn't mean since I got allocated 4% last year and I get allocated, let's say 4% this year, it's my intent to give them the 8% this year because
It is or is not?
is not my
Okay.
intention. Because you can get into, then they're focused on, we need the 8% each year to make this work. And that's one of the concerns that I have. We got to be able to manage this for a long period of time here. And I think that's, in my opinion, that's short-sighted.
Okay. Well, and I would and I think you're probably right. We probably need to, we may want to schedule a special meeting to specifically talk about that portion of the spending policy and make some decisions to give staff some direction. I'm not worried about them thinking that it's going to be 8% every year because we're very clear about what the percentage is, and if they miss budget, then that's kind of on the operator. But I do see what you're saying, and I do see the difficulty of it cascading. Mm-hmm. So we will. So for today, looking at what Randall has presented, are we comfortable with the 4% and approve that percentage for the distribution for this year? Any further discussion?
I guess my only question on that is, it circles around that same conversation. How would we be forecasted that any one of these needs was greater than the 4% distribution that we're looking at today?
We don't. Kind of, so what our responsibility is to manage the corpus, manage the trust, based on the guidance that's in the indenture, which is like for 40 years. And what it says in the indenture is at least 4%. I think that there may be years in the future that we would take that into consideration, but I think so few of these operators are up and running, the facilities aren't complete, so they're not in operations yet. I don't think that's as much of that's not really something for us to worry about this year. But I think when we have the spending policy conversation, I think that's something, I hope you bring that up again for future years.
Thank you.
So, I mean, to his question and around that point, 4% is the minimum that each one of these organizations can receive, but to the point that it becomes a greater need than that, is there in the policy that says up to X amount, not to the detriment of someone else's allocation, or not to the detriment of the corpus?
Right.
So I understand, I think that's what we're ultimately getting at with what you're saying, that, hey, I haven't used anything in 3 years, now I need 3 years of my distributions. Like, okay, well, that's going to take too much money from the portfolio. So to your point, Madam Chair, we do need to make sure that's clear in the spending policy.
I agree. Yeah. Because I can, in the next 40 years, there is the likelihood that the market is going to, not the market, but the economy will have a downturn and the operators will have some difficult years. So thinking ahead on what the trust's parameters are is something I think we need to be thoughtful about. Go ahead and get in front of it. So a more robust conversation than you might have anticipated.
Good.
Randall.
I did anticipate it, actually.
Good,
Yeah.
good. Okay. So with that, is there any further questions or discussion? Okay,
I'll make the motion to make it 4% for this next fiscal year.
thank you. Do we have a second? Motion passes. Thank you. Comments from trustees, staff, or interested persons? I don't see any interested persons. Okay, any comments? And I would just like to say, Mitchell, thank you for helping Doug and getting all of our information pulled together and the policy changes. Any other comments? If not, item 5, we are adjourned.